all of the major economic regions, their growth models are broken. So if you look at the US, the kind of debt-fueled consumption model of the 90s and the early 2000s, that model clearly ran out of gas in 2008, 2009. In Europe, the Euro system, which really was kind of almost a financing scheme between the Northern European countries who would be the producers and the Southern European countries who would be the consumers, and they consumed way above what they should have because for the first time in modern economic history, they could borrow at effectively German rates. So of course they consumed way more than they should. Again, 2008, 2009 put an end to that. And then thirdly, in the emerging economies, the heretofore growth engine of the world really, they too have had their growth model, which was more of an export-led, investment-led growth model, very dependent upon consumption in the developed economies. That model also fell apart post 2008, 2009. So one key point is that growth models concurrently around the world are broken, and that therefore there's no single economic engine to pull the world economy along. The second point is kind of how we've tried to manage the deleveraging, and that is principally through using monetary policy or central bank policy and what's known today as quantitative easing, kind of extraordinary central bank policy to buffer the deleveraging, which is the natural effect of coming out of a financial bust. The problem with this, though, is that the monetary policy tends to lead to a couple of additional risks. One of those is asset bubbles in the financial markets, and some would say we're maybe starting to see early signs of that in certain financial instruments. And the other is the risk of currency devaluation and trade protectionism, kind of a beggar thy neighbor policy, which we saw, of course, to very poor effect in the 1930s and the Great Depression. So today we're at a situation where we have the aftermath of a financial bust. We have world growth models broken concurrently. We have a dependency on monetary policy, which carries with it the risks of the financial bubbles being blown up again and beggar thy neighbor devaluation policies. And so we're stuck in kind of a fork of the road, or we've approached, maybe not stuck, but we've approached a fork in the road. Down one path is continued devaluation and competition for this limited amount of demand that exists. And it's kind of like if you think about a pie, right? There's a fixed pie, and we all want our various pieces, so we're going to compete for that. As opposed to how do we grow the pie, make the pie bigger so more of us can consume more and do better. And so that's the other path. One path, fixed pie, compete. The other path, grow the pie and allow more people to be more successful. And I think the US, in a way, is faced with, therefore, two challenges, particularly the policy-making community in the United States, economic policy actors. On the one hand, they need to generate a more robust growth path here in the United States. On the other hand, they need to do that in a way that sustains globalization, because we're at risk, I believe, of the second great try at globalization, the first ending in the Great Depression, failure. The second is now at risk of failure too if we go down this path of competitive devaluation. So the US policy community faces domestic challenge. How do we generate better growth than 2%? How do we bring down 7.5% unemployment? How do we protect against rising inequality within our society and all the ills that generates? In doing that, how do we generate a globalization policy and process that allows for the world as a whole to heal, not just the United States? Because one of the risks is that, for example, if we just say, let's go back and instill a debt-fueled consumption culture again, try to do the same thing over again, what that is likely to lead to is a lot of our demand leaking offshore. In other words, the jobs will come outside the United States, the products will come in, but the US, in terms of our own employment and our own growth of the middle class, doesn't get any better. So we need to come up with a new model. And I think the good news is that the United States is actually reasonably well positioned to do that. We have, I believe, what I've called and termed in the past the rebirth of middle America. And that is an important concept to think about. And it really has three components to it. The first is the energy boom, which allows us to produce electricity at a cost that's a fraction, less than a quarter of what it costs in Europe and Asia, and therefore really improves our competitive positioning. Secondly is what I call a manufacturing revival or renaissance in the United States, which is fueled by a 30-year kind of decline in manufacturing and therefore a lowering of our labor costs, making us more competitive. At the same time as there's a new trend, what's called kind of advanced manufacturing techniques, which really is, I believe, totally flipping the traditional multinational labor search on its head. I mean, if you think about it, the last 20 or 30 years, multinational corporations have focused on where can I find the cheapest labor. Advanced manufacturing turns that completely on its head and says, how can I be closest to the end consumer? Because I'm going to be able to do mass customization and I'm going to have much shorter product cycles. So this is a very, very important component. And I think, for example, we've had a lot of talk about offshoring of jobs and things of this nature. The new trend is going to be onshoring. People coming back to the United States to produce because we're more competitive, because we have cheaper energy, and because we continue to have, even in a weakened state, a very large, obviously, consumer market. We're a $16 trillion economy, 70% of which is consumption. So that is a very important market. In the third phase to the rebirth of Middle America, so first the energy, second the advanced manufacturing, the third is an agricultural boom. In the heartland of America, we have some of the most productive farms and lands in the world. And as the emerging economies become wealthier, they're going to demand more food and more protein. And the United States is ideally positioned to provide that. And so you see that already in the price of farmland, for example. If you're to actually look at a chart that shows the price of high quality farmland in the central middle part of the United States, you'll see it's been on a dramatic upward rise for the last several years. One of the best performing assets actually since the financial bust of 2008 has actually been agricultural farmland, which if you think about it, says, why is that? Well, it's because the rest of the world is continuing to grow, albeit slower than they did before the crisis, but nonetheless still growing. And a big part of that growth is improving demand for proteins. And you have China, for example, which people don't really appreciate. China has very little arable land to grow food. And so they've become a big soy importer. They've just recently become a big corn importer from the United States, and that's going to continue. So the good news is that the United States is actually relatively well positioned to try and make this shift to a more robust growth path. But of course, there are some caveats. The first would be that we have a relatively low level of public and private sector investment. The public investment because of the desire to tighten fiscal policy, reduce our debt, reduce our deficits, and the private sector lack of investment in part because there's no demand. So companies have tremendous amounts of cash on their balance sheets, record amounts of cash, which they're in part returning to shareholders, helping the stock market go higher, but they're not investing it in plant and equipment and new jobs to the extent that they might because of that lack of demand. And so you have a situation where you have the public and private sector not investing. You have high unemployment and low income growth, which obviously also limits the demand and the potential for the US economy. And then you have a stronger dollar and a weak external demand environment, which is really limiting our ability to export and to grow our manufacturing base to service those exports. So you have a potential in the United States that's limited by these couple of factors and which is in need of a more robust policy response. And I think that's really the question. How do we get the policy response in the United States? What does it look like? And how does it both boost growth here and also stimulate the next phase of globalization abroad?